Hi everyone, welcome to the Finance Magnets Liquidity panel, riding the liquidity wave. My name is Hormoz Faryar, I am from ADSS and I am here in Abu Dhabi. And I'd like to welcome the guests. We have 5 guests today who are distinguished within their own fields and very experienced in the liquidity area. So I'd like to let them introduce themselves, and I'll start with Ben from Maybank.
Hi, I'm Ben Robson. I'm head of leveraged foreign exchange for Maybank Kim Eng in London. I have a career that has spanned, I think it's 4 decades now. I caught the end of '98, and obviously it's the beginning of 2020. I've worked at Goldman Sachs. I was managing director for CMC Markets Asia in Hong Kong. I ran Asia Pacific FX and Bullion for MF Global and was interim CEO for FIXI in London. And I am the author of Currency Kings, How Billionaire Traders Made Their Fortune Trading Forex, and How You Can Too.
You wrote the book. Manu?
Hi, I'm Manu. I have been an FX volatility trader for the past 15 years. I used to run the emerging markets FX desks at Deutsche, UBS, and then at VTB. I have been a portfolio manager on the buy side for a couple of years at Capula. Now at Drax, I am basically EM strategist.
You forgot Credit Suisse, where we worked together.
Oh, yeah.
For a little while.
Well, 6 years, 6.5 years. Yeah. I forgot it today. That was where I started my career in FX options trading. Yes.
Great. Andy?
I'm Andy Biggs. I currently am the head of liquidity at CFH. I started my career at Sugden, working on the liquidity side there, and then helped start a company called IS Prime. And then in 2018 moved to CFH to run the group's liquidity.
Great. Alexei?
I'm Alexei Zhiltsov. I'm a co-founder of TradeFeeder, which is a fintech company aggregating the market data and transactional data across dealer-driven market, especially FX. And before that, I have an experience going back to 90s, I guess. I was a systematic trader, and the last kind of banking place where I worked with was Lehman Brothers, if anybody remembers that kind of institution. And after that, I co-ran a currency fund for about 6-7 years, being on the buy side as well. And now I'm with a company which aims to improve the dialogue between buy side and sell side institutions on liquidity management.
Great. And Richard?
Hi, Richard Elston, group responsible for institutional markets at CMC Markets. I've been around, I guess, probably since the mid-90s in the city in one shape or another, having worked in the last 15 years for IG and Saxo Bank. CMC, as some of you know, I mean, Ben certainly worked there as well, and we've been around since 1989. I always use that term, kind of one of the founding fathers in the retail space, but things have moved on somewhat since then. I'm sure we'll discuss some of those points as we go today.
Yeah, great. Thank you very much. So we don't have too much time, so I'm going to go straight to the point and start with some questions. We will maybe take some questions that I've prepared from the audience. So I wanted to ask you guys, what happened to the gold? I know we've had volatility the last couple of weeks as well, but what happened to the big moves, and what happened to the gold and the physical, the spreads? They went from 10 cents to $1, 5, 10. Perhaps if I start with Alexei on the sort of gold story of this year and the liquidity in that area.
Interesting thing about gold, I'm probably less qualified to talk about physical golds. Our clients don't do physical gold, so I will leave it to somebody else. I have an opinion, but I don't have any hard data to support it. But on gold in general, I think obviously what is very interesting from a pure trading perspective is a well well-defined and well-known intraday pattern, which never kind of disappears. So gold goes down during afternoon, kind of morning and afternoon London, and gold goes up overnight. This is a very strong pattern which we keep on positioning and telling to our clients in terms of execution kind of requirements. Because if you want to buy gold, you better buy it towards the afternoon. If you want to sell gold, you want to buy it, you want to sell it in the morning. It's very strong. It kind of keeps on going, and it's not particularly well. It has something to do with banks' activities, but this is something which didn't disappear over the last. The first time I looked at this pattern was about 10 years ago, and kind of it's still there. It doesn't disappear, so nothing changes. Apart from that, on gold, from investment perspective, obviously, negative real rates are especially conducive to gold upside. But not much to say about liquidity. I will leave it to more kind of informed people on this side.
Richard?
Yeah, I guess it's probably not worth going over so much what happened or during the period at the end of March when the dislocation first started to kick in. Sure, I mean the settlement wasn't possible. I mean, who would think a transportation of physical gold to New York was? I mean, these are unprecedented times. It's something that you might not even consider until it happens. Of course,
like disruptions. Yeah.
I mean, you mentioned $10 it went out to. I mean, we definitely saw. At the time, going out to $70 and beyond. I mean, it's suddenly looking at providers who were out there in the market. If I was
spread of gold was 70.
Oh yeah, absolutely. So in certain places, I mean, you're going to be able to do better than that. But I mean, there were certain providers out there that were pricing so widely it was beyond usable really as such. But if I reflect back and I look at if we were to look at, let's say, the top 10 feeds coming in. That we would reference, I think 2 of the tier 1s we were able to get a price off. Yes, if you were looking at the ECNs, of course you'd be able to find a price, but at what conditions? I think we consider ourselves upon reflection fairly lucky. We were looking at various futures sources at the time on a global basis as well, and we were able to continue to price to our customers. But yeah, I mean, it's an absolutely unprecedented situation that has righted itself somewhat. But I think the sense of foreboding is still there in the market. And if you look at price, well, it is pretty much back in line. But there are moments where it falls away again, and yeah, and really not much more to say than that, I think.
Yeah, Andy. So. If I can just ask you, your clients, were they complaining about gold? Did you see any major? Is that the biggest major thing, the gold story of this year?
For us, I think maybe not of the year, but certainly of March. I mean, we got quickly wrapped up then in negative oil, but
yeah.
At the time it was the first thing that was just a real surprise to us. As Richard said, I think the Swiss closed a particular region that had 70% of their refineries in, and my experience is with OTC gold, not with physical gold at all. So the fact that had such a huge impact on the liquidity that we were able to offer our clients was a big surprise. And I think there was the days it happened. We have lots of spread filters and protections in place. And we were having to constantly kind of reevaluate them to see that we could give a price out to our clients. It was definitely an interesting couple of days, and then we're also surprised that the fact it didn't really stabilize, and some of the issues with in the COMEX delivery not accepting London bars was again new to me, but really interesting. And still, we think it's not quite back where it should be. We're still not quite where we were in kind of the January, February times now. A little bit that's due to volatility, but also, I think there is some trepidation still that it could happen again.
Yeah, Ben, from your perspective, the gold or anything to add in terms of maybe the Maybank is Asian bank, maybe they saw a bit of, Asian story there as well.
Well, my view on gold is it's inherently volatile, as is silver. And for retail clients, we as a bank, we use a prime, and so we're margined quite heavily by our prime, and we have to compete with other brokers that will offer gold on 1% margin and show spreads of 8 to 12%. And so, my view is that the gold and silver are quite volatile. There are episodes in the last 10 years where silver certainly has dropped 11% on 2 occasions, gold 9% on 1 occasion, and people aren't really looking at the risk of this. And so it doesn't surprise me. Obviously the situation in March was a short squeeze for people who wish to deliver gold on exchange. And obviously there was some volatility in equity markets, which may have pushed people to buy gold on exchange. But in general, the gold market is essentially a retail market, certainly on the OTC side, and people are discounting the risks. And I believe that sensible risk managers should actually impose larger margin requirements on gold. And it doesn't surprise me that spreads can explode in times of volatility.
Yeah, Manu, I think you're on mute, by the way. But yeah, so from your perspective, JB Drax, and what you saw in gold, what's your thoughts?
Well, my thoughts was that what happened with gold was a combination of both people getting very worried about the nature of the markets and certain structural issues, like a delivery could not happen from London into New York. And second, the definition of a good delivery bar between New York and London is different. So New York uses a different, so basically they had to even rejig what is considered a London good delivery bar to fit US standards when bullion was shipped from London to New York, etc. And that was one of the big reasons why the spread went the way it did. However, there was genuine demand from people who were thinking that basically the world is, the sky is falling on our heads. So that also we saw. Then after which the second leg, so that was the first leg, extreme panic. The second leg was when the government announced, all this fiscal stimulus and everything. So everybody jumped onto the bandwagon that fiat is going to be devalued. And that is where we stand now, basically.
Yeah.
And that's
I think one of the things we noticed, of course, in the middle of all this, you have the non-banks performance came into light. Usually they've done so well, the non-banks in the industry. And Richard, I wanted to ask you, what happened with the non-banks? So we hear stories that they're not there. They weren't there when you needed them. You expected them to be there, or shouldn't people expect them to be there? What happened with the non-banks and gold and FX in general versus traditional banks, I would say?
Yeah, it's hard to get away from, isn't it? I suppose that there is always that sentiment hanging in the air that when things are going smoothly, then the algo at the non-bank is pricing in an advantageous fashion for you as a taker, and as soon as things get out of line, then maybe that isn't quite the case. Frank, where gold specifically is concerned, we had a better sense of reliance on the tier ones. We're in a slightly unusual position, I think, generally across the FX market, and this is speaking very specifically about ourselves. So I think that we did a white paper, and I only released it the other day, but it was it was a revelatory exercise for us going out to our client base, and we felt that, I suppose that one of the standout points was that market impact was an area that was very dominant in the list of wants and needs of our clients. When we look at the non-banks, they kind of fall into that lacking or not generating market impact in terms of trading with them as well. But if they're going to fall out of line, then where do we go? We see ourselves, I suppose, in a situation whereby we feel that we are more of a non-bank market maker ourselves than we are a recycler of other liquidity, which would bring us into question, I suppose, in that particular vein. But taking that ability to generate your own liquidity, I guess, as such, utilizing our retail client base. I mean, we've got 40,000 clients beating the living hell out of the machine on a daily basis. Combining that with the institutional flows and combining that with the various price referencing and ability, and of course we're going to hedge in the market as well. I mean, find me a non-bank that doesn't also cover itself. Then with a bit of luck, you've got a fairly perhaps not unique but solid proposition. So yeah, it's difficult to say that the non-banks are always going to be there in times of crisis, but we found from ourselves that we were still, goes back to what I said maybe in the first question, we were still able to be able to get pricing out there, courtesy of kind of the multiple sources of liquidity that we have available to us. In fact, that white paper, I mean, the simple title of it, and I'm sure it'll be kicking around this week, is how can retail flow add value in the institutional EFX markets?
Yeah, great. Ben?
Well, yeah, I think that I'm not against non-bank liquidity, and on previous panels that you've hosted, I think there were some excellent points. I think Jeremy Smart came across very well the last time that there was a live panel, and he actually mentioned that XTX, obviously we all know is the biggest non-bank market maker. And then Lane Littman came across quite well on your previous panel from Virtue. But the point that Jeremy made, which I thought was quite interesting, is that there are really only 10 banks that stand out as liquidity providers, and a lot of other LPs regurgitate that liquidity, and they call themselves LPs. And I actually wanted to go back 20 years. I worked at Prudential Beige as a dealer, and liquidity in those days was given by the banks, and we went out to banks to cover our trades. So I worked closely with a guy called Mark Davison, whom you probably know. Mark Davison was a dollar yen trader, and he would make me a price in half a yard of dollar yen, but he had Japanese banks covering his back. So you have Neil Callard at Fuji, I think David Rose at IBJ. These were people that we could go to for dollar yen. And similarly,
were they always there when you needed them?
Yeah, they were.
For 500 million?
Well, yes, they were. They would make a market, yeah.
Those were the days then.
Well, similarly, you would have the Swiss banks that would make you markets in Swiss francs, and the German banks that would make you markets in Deutschmarks and then subsequently euro, and the British banks that would make you prices in cable. So if you move forward 10 years, I had an electronic platform, and one day Reuters went down, and all of a sudden, I think half of my LPs that were banks disappeared. Their spreads widened. So it's quite clear that they took a mid-price added spread, maybe skewed it which way, one way or the other. Right. So now we move on to today, and we have a lot of people scrambling to be top of book in very small amounts, right? Because they capture retail flow essentially, right? So when the market is volatile, those LPs, they're not really interested in making a market, because they're only really interested in small stuff that they can risk manage. So when it comes to larger stuff, and when markets cascade and stops get triggered, then you have to rely on the tier one LPs and the genuine non-banks that have their own variable inputs that can make them stand up as well. So I mean, it's a progressive problem which has got to today's age, where you've got millions of orders at the top of book trying to grab small amounts of flow. But when the market widens, that liquidity is spoof and it disappears.
Yeah, Manu, so what's your view on the non-banks? You've used them a lot. Again, I think you're on mute.
We use them a lot, and in my opinion, when times are good, they are what you call, they increase the liquidity. However, they also increase the instability of the system. The reason is that many of the non-banks, or so many of the algorithmic liquidity providers, in the end, most of the algorithms used will be working on the same deterministic logic. So which means in a given market condition, all of them will think the same way and go away at the same time. I mean, it's just computer science. However, if it is a human dealer, humans are much more likely to have varied opinion and therefore give a more stable market. So I agree with what Ben Robson was saying, that basically if you had a human dealer, it doesn't matter, even whatever is hitting the fan, you went and asked him, you would get a price in 200. When it's a machine driven by an algorithm, driven by deterministic logic, it's gone. So which means in that kind of situation, the market becomes very unstable, and therefore you are also, and it is reflected in the market price action, because if you look over since all these what you call the platforms have become more and more dominant and providers of liquidity, the incidence of 6 sigma moves, and then 6 sigma move is 1 in a million, has actually gone up by 5 times. 5 times in just the past 7-8 years. So clearly what used to be a 6 sigma move is no longer a 6 sigma move under current. So I think
we need more diverse algos. We need some kind of more diversity even in the algos.
Kamalin, what do you say?
Some diversity, or? No,
but the thing is, the algos are programmed based on basically any algorithm is basically, it's just a deterministic finite automata moving between states. I mean, if you look at it from an abstract perspective, how will you generate diversity in the algorithm? Because all of them will be using the same kind of, if this, then this, if this. I mean, the flow of logic it is not like human thinking. You get what I'm saying? And algos, they will all converge to the same conclusion because that's mathematics.
Yeah.
But human beings can have very varied opinion. So which is why when things get really tough, it is always better to have a human dealer. When things are fine, then yes, then the algos can provide you liquidity, which is basically 1 tick. The human may provide you 1.5 tick. But shit hitting the fan, the human will still show you a price when the machine is gone. And then you have these gaps. I mean, the flash crash which you saw in sterling. I mean, sterling behaved worse than any emerging market currency. In fact, even in March, sterling went from 122 to 114 just like that. What does that tell you, right? It tells you that there is something has changed about the market structure. And we are talking sterling. We are not talking about whatever XYZ currency. It went from 122 to 114, 2 trading sessions.
Yeah, Andy, what do you think? I mean, I think quotes of $500 million in person, less algo. 20 years ago, you and I were at kindergarten, I guess, but things were different, it seems. Do you rely on humans more, or?
I think we rely on humans less and less. And I think I completely agree, with the comments that have been said earlier. But the issue is those human traders tend not to pay for themselves in the 90% of the times where markets are good because they're being outcompeted by 0.1 on euro-dollar algos. And I don't see a particular fix for that. And I think that there is going to be a problem where flash crashes are more prevalent. And do you get human traders in then just to handle the kind of stressed market scenarios? Possibly. It's certainly not an easy question that's got a simple solution.
Yeah. So did you see non-banks? How did you see banks versus non-banks, Andy?
So I think non-banks come in lots of different shapes and sizes. So I think we saw both banks and traditional banks struggle over the gold issues. I think we saw some non-banks then actually come to the fore when in the kind of the recovery phase of that. So maybe not initially, but certainly in the weeks after, I think the non-banks were able to change their models quicker to provide pricing that we thought was the best out there. But the banks are just extremely reliable, and that they are going to be there. If you are in a stress scenario and you need to get out of a position, it is very likely you'll be able to get an offer from a bank. Whereas the non-banks, some of them will either not be there, some of them might be there but might not have updated their models, so aren't there. So I think certainly the non-banks have seemed to have the advantage in terms of reacting to new situations and changing so that their models will price better, but the banks are always going to be there and always be reliable. So I think you need to have a healthy mix of everything.
Yeah, I feel like, you know, here at ADSS, we felt that clients were looking elsewhere. Like we picked up a lot of clients who said, look, we are very focused. We have Michael Taylor and team overlooking at the central, he's heading up the front office for us in a centralized dealing desk here in Abu Dhabi, and very focused on liquidity. And we felt a lot of clients came to us saying, we want that analytical focus that we have in terms of, you know, they weren't super happy with the LPs out there, not necessarily, maybe because they needed some more analytics and ways to find out what's the best way to deal with issues like this. So Alexei, what did you guys see? You analyze a lot, right? This non-bank and banks.
I think there are quite a lot of topics here. First of all, I want to address a couple of very good points. The first is just purely mechanical increase in volatility. During COVID, you know, sell-off, the increase of volatility was 5 to 7 times in FX, judging from, you know, dollar NOK all the way down to euro dollar, less increase in volatility because it's a very stable asset in general. But what we see is that obviously banks operate on a risk budget, and risk budgets are much bigger in banks and much smaller in kind of non-banks. Not much smaller, but smaller. Even though they will tell you different non-banks will tell you different things. Virtue will tell you one thing, and XTX will tell you another thing. And I'm not positioned to. You have to listen to what they say. But what is interesting is that it's a usage of liquidity. If especially, you know, if you use non-bank for a specific market environment, you have to you don't always have to act the same way. If volatility goes up, if there is a very directional market, if you believe that certain dealers are better in this market, and this is all down to data, you can easily do a switch in your liquidity management. If you believe that, you know, rejection ratio is increasing quite considerably for certain LP in those market conditions, don't use them in these market conditions, use somebody else. And the models based on volatility are generally quite, apart from your physical gold thing, where there's a feedback loop from a physical instrument. In FX, the spreads are pretty much driven by volatility on its own, with changes in spreads. Volatility triples, spread triples. Volatility doubles, spread doubles. It's literally as simple as that. And now the other thing is market impact, what Richard was talking about, is also a function of volatility, is a function of your speed at which you are trading. And again, you can switch. Yeah, if you're trading with kind of non-bank market maker in a normal time, and it works for you, but you know it's not going to work for you in a kind of volatile environment, then switch. Don't switch. Have your regime switching model, which trades differently. And finally, on the topic of, you know, yes, those days back in 20 years ago, when somebody was able to do, you know, 500 all the time. I think it reminds me of the story about pilots who used to fly without autopilot back in the day, but now autopilot goes down, and that's it. They take a plane, but they cannot fly anymore. I think similar scenario happens with traders. They operate in an electronic environment. They're so used to this market that nowadays it's okay. Now you're on your own. You have to make a price, and you don't know what's going on. They're just not as good as they used to be. But that's natural, because I wouldn't even say it's good or bad, but because the market we have now is arguably much more efficient in terms of the amount that we pay on average on visible spread, or even on adjusted spread, adjusted for market impact and all sorts of other things. So I would say efficiency is still there. And I would just say, don't expect from non-market makers that we will be there if they're not. And finally, just for the record, I strongly disagree about algos being deterministic. They're not.
They're not.
They're not. Deterministic algos are like 15 years ago.
Okay, Richard, how was your risk book? How was the book? How was you know, big brokers made tons of money, yes or not, this year?
Yeah, there's not really any other way to say it. I think the brokerage industry, I mean, we've got to consider ourselves pretty lucky. I mean, you look at this on a human scale around us, and we're very fortunate to be in this particular industry. So yes, I think brokers did do very well out of the COVID crisis. I think there's more to it than that. I mean, you had two completely bizarre events occur this year. Yeah, we covered gold, unprecedented. You know, can't shove gold on an airplane to get it to New York. But you know, we had a lockdown of traffic of practically every kind. I mean, back in March, we really did have a global shutdown. WTI crisis came off the back of, you know, whether it's as simplistic as people not driving their cars or aircraft not taking off to the same extent. I mean, we were in a bizarre scenario that is just not being seen by the planet. And the levels of volatility, I mean, where are we at the moment? I guess the VIX is around 25, something like that. Significantly different to where we were earlier in the year. So, you know, volatility has come down. Are we going to see a repeat of those conditions that have inspired the creation of big profits? I don't know.
Do you guys have any specific numbers? Like, did you get a lot of, like, what was there a record year for the last 10 years or something on the book side? Or
it was, you know, I genuinely don't know that. I suspect it's in that zone. It was an extremely good year. And one thing I guess that's probably fueled that profit is there's been, and we see it as a provider of liquidity through, you know, API technology, that the takers at the other end of it, it's just the internalization rates have gone up massively during the course of this year, and that probably applies to us as well. So it's been a different year.
Meaning you would take more risk? Oh,
absolutely.
You took much more risk throughout this year than, let's say, last year.
The levels, I guess, I mean, certainly the levels are maybe specifically unimportant, but would have been more than the equivalent period in the last year, and we definitely see that from our customers as well. But and I think it's just, you know, it was a industry mantra during that period that, you know, we're just taking more on. I would guess that you know, Andy might be able to corroborate that from his experience. I'd be interested to know, and anyone else who could chip in. But I think that's pretty much the case. Yeah,
Ben, how about from Maybank's perspective? Any specifics, numbers, risk, volatility, you know, performance, book performance, anything like that?
I can't really commit to giving information about that sort of thing. But having said that, I know that we have had a busy year, and I know that we have a significant interest. Actually, the appeal for Maybank, or to certain customers, is our balance sheet and the integrity of our pricing. And you know, we obviously work with prime brokers, I mentioned before, and there is some comfort in volatile times that people have a big place where they can feel safe with their margin. On the specifics of the volatility, I mean, obviously March was a big event when COVID really struck, and but my concerns, and obviously you've had oil and you've had elections, but the volatility hasn't been very severe during the elections. I think probably what we will see is more volatility in the future. And you know, the reason I say that is because in the Trump presidency, you know, Trump has really been pro equity markets, and he's been quite forceful against the Fed, and so he's kept equity markets buoyant. But actually, there's this massive concentration risk in a few stocks in the S&P. I believe 26% of the S&P is made up of FANG stocks, and on the Nasdaq 100, I think 50% is made up of Facebook, Apple, Amazon, not Netflix, Google, Microsoft, and Tesla. Right, so there's this massive concentration risk in equity markets, and I believe as Biden takes over, you know, you've got the aftermath of COVID, and there could be huge economic distress, which you know, can start off in equity markets, but then you can get contagion in other markets, and that can be commodities, and that filters through to currencies. So you know, I don't think the markets have been tremendously volatile, aside from the COVID episode in early March. But I do believe that the future, there will be much more volatile.
Yeah. Manu, risk books, JB Drax. We really want to hear about this time. You're on mute still. And I really want to hear JB Drax. How was the performance?
Oh, we had a record first quad and second quad, absolutely smashing all records, because the nature, means the unexpected nature and the violence of the moves meant there was a lot of a demand for specialized knowledge and a lot of demand for execution and price discovery. Because many people, many of the big asset managers, they were flying blind as to where the price of something is. So yeah, we had a absolutely smashing first and second quarters.
Yeah, Andy?
So yeah, I mean, CFH doesn't take risk, but from a volume perspective, it was a fantastic Q1 and Q2 has been a fantastic year. And then to a question that you sort of mentioned earlier on, I think anecdotally, books did extremely well, and off the back of that, and off the back of that profit that lots of clients have accrued, I do suspect that people are increasing limits in B books, which is hard to blame them for, really. So I think although we're still seeing quite a lot of flow STP to us or A book to us, I suspect the total amount of flow that our clients are seeing has gone up quite a bit.
Yeah. I mean, okay, so it sounds like it was a great year, but if I would have told you 10 years ago, 2020, all this stuff, Corona, lockdowns, election stories, negative oil and all that stuff, you would have thought that definitely this would have been the most volatile year in the last 10 years from a VIX perspective or whatever measurement you would want to do in anything. But was it the most volatile in the last 10 years? Alexi, Andy, do you have some stats on that?
So, maybe? I mean, Manu as a volatility trader is probably better to talk about this than I am, but looking at the CVIX, which is kind of a currency volatility index, almost every year since 2015, it's just got lower and lower and lower and lower. We saw, Jan started out as a record low for it, and I remember having conversations in January going, volatility is dead, that's it. What a disaster to be in FX markets. And then you see March, and even with all of COVID, I think it was only above the volatility levels of 2015 for about a month before it dropped below. So I'm by no means the expert on volatility, so I'm interested in some of the other panelists' thoughts on it. But I'm surprised at how quiet in comparison to previous years we are.
So it looks like it's not
given
more volatile.
Everything that's happening. Yeah.
It's not more volatile than 2016 and 2015 this year, essentially. Is that right, Alexi or Manu? Do you guys?
I think, yeah, it depends on the measure, but obviously, yes, the volatility, as Andy said, and volatility is kind of only jumped for a couple of months, and then especially in FX, it's subdued dramatically, basically back to the levels of almost 2019, slightly above. VIX is holding up there. Yeah, we're not going to see, 10 handle or 12 or 13 handle. We're still like in mid-20s basically, and sometimes we occasionally go to 30s, which is not normally consistent with Ferrari in equity market and all-time high, but that's just the way it is, and probably related to recent elections and so on and so forth. But definitely, as you mentioned, volatility is not what you would expect from a year which is probably was more dramatic than like all the way back to, I think, 2008. It was probably in terms of dramatism, that's the year which is probably comparable to 2020, but volatility is nowhere near that levels. Reasons for that, hard to say. I think it's we can discuss the reaction to events, it's probably later, but I think what was interesting with Manu's comment, especially like high volatility demand for professional execution services, we saw in institutional space very similar shift to demand for algos, effectively. So high volatility. Obviously, B books are making a lot of money on retail space, and also B books, well, not B book, risk books are making a lot of money in bank space. But more kind of sophisticated institutional clients also were demanding algos, because suddenly execution, which is done in a market which you would have thought is completely the opposite, and okay, you don't want to rely on algo, you want to rely on human because the world is very volatile. But actually the demand for FX algos especially was quite strong during this COVID period, and people were trading a lot of algos through this is you can read every bank. It's kind of, this is what is observed, and that's natural, because that's comparing this to the alternative. Alternative is to execute at a risk price which is quite wide, and that's why the P&Ls are quite dramatic to all the big box. That's, I'll probably stop on that.
Richard, did you want to add something to that?
I'm on mute.
Yeah.
Going back to one point, I suppose, before, I mean, in terms of market making, I feel, I don't feel a lot of quite strong conviction about it, really, and there's certainly no shame in the matter. I think that if anything, the market making element is adding that liquidity that is actually providing or doing the job for its customer that it's designed to do. I mean, I look at, slightly away from FX, but I think a really good example is if you look at something like the DAX. I mean, I used to be a DAX trader 100 years ago, and even back then, I mean, looking what you would actually see available at top of book at the time, well, it was better than it is today. And you're seeing a few lots, 1, 2, 3 lots maybe in really good times. I look at the added liquidity that market making brings to the table in defense of it. And I see that we're able to, to offer 9 lots at top of book effectively in the DAX. So yeah, unashamed market making is actually a positive thing from my perspective.
Yeah, Manu, was there more money in 2008 in volatility, or 2015, or 16, or this year? Volatility money?
No, this year, I mean, in the time that I have been in the market, 2008 has definitely not been beaten by margin. But what has happened, because the structure of the market has changed, now what you have is nothing, then a digital move for a few sessions, then again nothing. So earlier the moves used to be analog. So a skilled trader could plan in advance, recognize. Now it is more like nothing, and then digital move. So it also reflects the increasing prevalence of algorithmic trading in our space, which is why you have nothing, and then suddenly whoosh, and then again it comes back down, stays. And this kind of price action, obviously, now timing the days on which those digital moves should happen is a lot tougher than being able to kind of predict a more analog, reaction function in the market, which is what used to happen. So purely in terms of realized vol, or what you call observed vol, this is very, I mean, the violence, so the amplitude is definitely higher. So for some assets, we saw the speed of the move was extraordinary. It was similar to what we saw in 2008. However, the days for which this price action prevailed was very small. So if you were to take a weighted this thing over the course of the year, I mean, 2015 would beat it. Forget 2008, 2009.
Yeah. Ben, I think, flash crashes were covered quite nicely in your book. A couple of flash crashes there. I read your book, Currency Kings. I think Richard's got it in his bookshelf over there.
I wrote about his boss, yeah.
Too sophisticated for me.
No, it's a good book, Currency Kings. But so in there, you mentioned flash crashes. So do you agree with Manu? Are we going to see more flash crashes then? Are we going to see just flat and then flash crashes? And then that doesn't sound great.
Well, there's evidence of flash crashes pretty much all the time. So it depends which product. I can list a few, but I mean, we go back to 2015 in January. That was a massive one in the currency markets. Obviously, the euro Swiss depegging. But you know, in 2016, we had a flash crash in South African rand. We had another one in sterling. I think in 2017, silver. I know 2019 and 20, Aussie dollar, once against the yen. But even in equities, you have these, people look at currencies and they say they're volatile and they're dangerous to trade because you trade on margin. But if you look at the average equity, Twitter in probably the last 3 years, it's had 2 days where it's dropped over 21% in an instant. Right, so going back to March, we had massive moves in palladium and platinum and copper, and obviously you had the issue with oil. So are we going to get flash crashes? The answer is absolutely yes. I mean, where they stem from is what we have to try and sort of figure out. And in answer to your previous question, I mentioned this buoyancy in US markets, that people think they are always going onwards and upwards, that they're desensitized to risk. They know that if there's a little crash, then they buy the dip, and this is what we call optimism bias, and people are doubling down on bad positions, and they're getting wiped out when the markets move south. Only on the 9th of November, we had equity markets obviously had a bit of a Biden rally. Simultaneously, gold dropped 4.5%, and I mentioned earlier, if people are long gold on a 1% margin, you know, that's going to cause them significant grief in their portfolio. They could be stopped out with having lost all their money, right? So, you know, there's going to be flash crashes from here on in. It's only 20 years ago, let's go back there again, NASDAQ peak to trough, minus 78%. 2008, 2009, the S&P dropped 50%. Now, people have short memories. You know, there is massive risk in the markets, and people are unaware of it.
So Andy, do you think we're going to have more kind of this flat and then flash crashes coming up? And with all the money printing, we might see, you know, magnified stories.
Yeah, I mean, I couldn't agree more on the digital moves. That's something we've seen even in the last 5 years of volatility jumping for an hour, and then that's it. I think on just going back to volatility in general, I think towards the end of the year with stuff like Brexit and a bit of the election volatility hangover, it's going to be an interesting time to be in the markets, and also a dangerous time. So whether we see margins increased across the board from prime brokers or from liquidity providers as we head into kind of December, January is going to be an interesting one to watch out for.
Yeah, I'd forgotten about your Brexit story sitting out here. That's still at play, huh? Manu, what do you think? It's gonna be a bit volatile, huh? From now on until January, a bit of continuous election issues, maybe a bit of Brexit volatility.
I think it will be volatile. Brexit, more or less, it will be I think headline volatility more than any kind of structural volatility, because the UK is going to fold. They have very few good cards in this. So Brexit, I think it will be a more smoothing than the volatility which is going to come out of the US. I think that is a big unknown. And plus, as we are seeing month-end price action, and that is many times even coming from corporate behavior and say dollar funding behavior, etc. Many counterintuitive things are happening. So yes, I definitely expect idiosyncratic volatility, definitely in December and in January too. I'm very fairly convinced of that. Brexit might be one of the more predictable things than, I think US will be the bigger source of volatility than Brexit will be.
Alexei, what do you think? Future volatility?
I agree with that, actually. Brexit may be a local story. We're all kind of, because we're living in the UK, we're extremely kind of positioned to, I watch the newspapers and I kind of react to everything. It's also related very much to flash crashes kind of scenario. I was going to add that, you know, electronic market without flash crashes is like, you know, capitalism without bankruptcy. So it has to be something like this. It's like a generic feature which has to be there. In terms of volatility, yes, I think it will come from US, and the reason it will come from US is that attitude to Fed and kind of the supporting policy will be extremely uncertain during the 2021. What will happen is that obviously we're all sitting on double-digit budget deficits in governments, and some countries also have a huge current account deficit. We don't even have to mention them. So this kind of double whammy will generate a huge demand from also COVID kind of recovery to create more and more capital, and there will be lots of political fights of how to achieve it. And this will result in a big kind of misunderstanding and volatility. The counter argument to this is that once it's all solved out, the volatility will be extremely kind of one-sided, shift down and quickly down, and then kind of slowly going up, going to the argument of buy the dip kind of crowd, which is always there, and which is always trying to pick the kind of the bottom in every single asset class. The interesting bit is that in effects there's no bottom because it's not clear what to buy. Euro dollar, dollar euro, basically. It's not a one-sided class. But I would expect a lot of volatility in 2021 once we go past the kind of the new president joins in, and we have to deal with aftermath of COVID, because now it's like not even clear. It's like, okay, we have to create capital, we have to support the economy. But once this is going to switch, it's going to be very close to what we remember in 2013, 2014, 2015, taper tantrum, and all this kind of Fed kind of slowly getting out of this mode of printing forever. So that will be like, I think I expect it to be like 2015 in a way, because we will be forced to act faster because we simply cannot produce money at the same speed. So if anything, look at 2015.
Yeah. Okay. I spoke to Richard about this last week briefly about, I think, Richard, you were saying you used to have, I don't know, 50, 60 meetings I don't know, per month, maybe face-to-face. And now it's not many meetings. They're hampering some of this stuff as well. The next year is going to be fine, but, you know.
I guess we touched on this earlier, really. So, you know, I feel sorry for sales staff in terms of how they conduct themselves. It's very difficult. I think, you know, there's been some illicit meetings going on in London where people, are irrespective of the fact whether they're in the office or not, people of their own initiative are getting together and trying to, you know, create some kind of semblance of a normal working life. But yeah, you know, we were joking about this prior to the sesh today. But you know, when you wake up in the morning and you've got a big roster of Zoom calls to do, as opposed to actually sitting down with human beings. I guess, I suppose, in reflection, when we look at how matters have performed commercially, if you had relationships that you were already in fostering that, or rather they were already in situ at the time, then it was fairly okay, I think, for the outcome, the correct commercial outcome to occur, and you just see that through to the end. Fostering new relationships, I think, is tougher. That doesn't mean to say that inquiries have gone away, and there is interest out there generally in the market. And we go back to that white paper we mentioned, and also something you discussed earlier, almost from ADS's, or rather, sorry, ADSS. His point of view, that that white paper revealed to us that during the course of, let's say, the higher volatility period, that 45% of takers out there went and looked for alternative sources. Now, there are reasons we kind of discussed today, but 45%, well, also means that 55% didn't. But 45% is a pretty chunky number of your client base that have considered going out there and looking at alternative liquidity provision across asset class as well.
Yeah. Ben and Andy, just briefly, is it this whole Corona story? Is it making the liquidity situation, volatility worse as well? That the fact that you can't be in touch with people the same way? Or is that not anything to do with the volatility and liquidity management story? The fact that you can't meet people as much. Ben?
Oh, I've actually been very lucky because I have met people whilst I've been in London. Obviously, you know, for next month it's going to be difficult, but there are people that go to work. Obviously, Richard goes to work. I go to work. A lot of people at Goldman Sachs go to work. You either meet people across Zoom who maybe your existing relationships, and I run the institutional side of the business, so you know, clearly I'm not under pressure to open 300 retail accounts in the year, but you know, I have reached out to institutional clients, and what institutional clients look at is obviously the, you know, who they're going to deal with. So on the one hand, you know, obviously I work for a big organization with a decent balance sheet. On the other hand, you know, I am working with some excellent liquidity providers. So all I wish to do is to have an integrity of price that I can offer my clients, and I believe that's actually a competitive advantage for me. Yeah. So you know, there are, as we mentioned before, there are supposedly 10 main LPs and a few non-bank LPs that are dependable. And if I have those all in my pool, and I would admit to not having all of them in my pool, I hope that someone tells me who the 10 are, then my liquidity is only going to get better. And you know, if we head into difficult times and more volatility, then I know that my price is going to stand up.
Great, Andy. Last comments. Has it been tough?
I think,
management?
you know, during lockdown 1, it was new, and I found it frustrating to not be able to go and you know, meet our LPs in person. If there are issues or planning for the future, I find it a lot easier to do in a meeting room or in a coffee shop than over Zoom. And especially right at the beginning, when banks hadn't really got round to using video calls, so you couldn't use something like Zoom. That was extremely frustrating. You know, as we came out of lockdown, you know, we are able to go into London and not meet in people's offices, but still meet, which, you know, I value significantly more now than I used to. So hopefully lockdown doesn't last for too long, and I'm looking forward to being able to go and meet a few people before Christmas.
Thanks, gentlemen. We're out of time. Thank you a lot, and goodbye from Abu Dhabi.
Thank you.
Thank you.
Thanks, guys.